The US stock market just slid due to AI worries, and now Asian markets are following suit. This phenomenon is called herd mentality, where investors follow the crowd without considering their own goals. Research shows that 75% of investors rely on social proof when making decisions, leading to a domino effect in market crashes. Herd mentality is a cognitive bias that occurs when people prioritize conforming to a group over making rational decisions. This can lead to a cascade of selling or buying, causing markets to crash or skyrocket. As Kahneman found, people feel losses 2x more intensely than gains, making them more likely to follow the crowd in times of uncertainty. In everyday life, herd mentality can influence our purchasing decisions. For instance, if a popular product is trending, we're more likely to buy it, even if it's not the best fit for our needs. This is because our brains are wired to respond to social proof, with 92% of consumers trusting recommendations from friends and family over advertising. The Vail Company's recent underperformance is an example of how herd mentality can affect stock prices. When a company's stock price drops, investors may panic and sell, further driving down the price. This can create a self-reinforcing cycle, with 60% of investors selling their stocks during a market downturn. Neuroscience research has shown that our brains are more active when we're part of a group, releasing oxytocin and dopamine, which can reinforce herd behavior. This is why it's essential to take a step back and assess our own goals and risk tolerance before making investment decisions. One way to avoid herd mentality is to educate ourselves on investing and personal finance. By reading books and articles, we can develop a deeper understanding of the markets and make more informed decisions. In fact, 80% of wealthy individuals attribute their success to self-education. Another strategy is to diversify our portfolios, spreading our investments across different asset classes and industries. This can help reduce our exposure to market volatility and minimize losses during a downturn. Research shows that diversified portfolios can reduce risk by up to 40%. It's also essential to set clear financial goals and risk tolerance before investing. By doing so, we can avoid making emotional decisions based on short-term market fluctuations. In fact, 70% of investors who set clear goals are more likely to achieve them. The UAE's recent exit from OPEC is an example of how unexpected events can impact markets. By staying informed and adapting to changing market conditions, we can make more informed investment decisions and avoid herd mentality. The oil market is another example of how herd mentality can influence prices. When traders focus on short-term price movements, they can create a self-reinforcing cycle, driving prices up or down. This is why it's essential to take a long-term perspective and consider fundamental analysis when making investment decisions. Gold prices have been steady after a 2-day drop, despite inflation fears. This is an example of how markets can be influenced by emotional factors, such as fear and greed. By understanding these emotional drivers, we can make more informed investment decisions and avoid herd mentality. The Fed's upcoming interest rate decision is another example of how market expectations can influence prices. By understanding the underlying economic factors and avoiding emotional reactions, we can make more informed investment decisions. Research has shown that investors who take a contrarian approach, going against the crowd, can outperform the market in the long term. This is because they're able to avoid herd mentality and make more informed decisions based on fundamental analysis. Another strategy is to use dollar-cost averaging, investing a fixed amount of money at regular intervals, regardless of market conditions. This can help reduce the impact of market volatility and avoid emotional decisions. It's also essential to avoid overconfidence, which can lead to herd mentality. By recognizing our own biases and limitations, we can make more informed decisions and avoid common pitfalls. The key to avoiding herd mentality is to develop a long-term perspective and focus on fundamental analysis. By doing so, we can make more informed investment decisions and avoid emotional reactions to short-term market fluctuations. Market crashes can be a wake-up call for investors to re-evaluate their strategies and avoid herd mentality. By learning from past mistakes and adapting to changing market conditions, we can make more informed investment decisions and achieve our long-term goals. The psychology of money is complex, and understanding our own emotional drivers is crucial to making informed investment decisions. By recognizing our biases and limitations, we can develop a more nuanced approach to investing and avoid herd mentality. In conclusion, avoiding herd mentality requires a combination of self-education, diversification, and a long-term perspective. By taking control of our investments and making informed decisions, we can achieve our financial goals and avoid common pitfalls. So, what can you do today to avoid herd mentality? Take 10 minutes to review your investment portfolio and make sure it's aligned with your long-term goals. By taking small steps towards financial literacy, you can make more informed decisions and achieve your financial freedom.